Hello, this is barontax and accounting again. All right, let's talk about something that can make your wallet a bit heavier come tax time, car tax deductions. If you're using your own car for work, and I mean properly for work, not just driving to your usual office, then you could be missing out on some serious savings. Many Aussies, from tradies zipping between jobs to freelancers meeting clients, and even small business owners making deliveries, can claim a slice of their car expenses back. It's not about dodging tax, it's about claiming what you're entitled to. Think of it as the tax office giving you a bit of a thank you for using your personal vehicle to earn your keep, covering some of that wear and tear and the fuel you've burned. Now, why should you really care? Well, every dollar you can legitimately claim as a deduction reduces your taxable income. Less taxable income means you pay less tax. Simple as that. In a world where petrol prices seem to be on a permanent skyward journey and car maintenance costs can make your eyes water, these deductions are more important than ever. It's your money, and getting these claims right means more of it stays in your pocket, not Uncle Sam's, or in our case, the ATO's. For a small business or a sole trader, these savings can be ploughed back into the business, helping it grow, or just helping you breathe a little easier at the end of the financial year. So who gets to jump on this bandwagon? If you're an employee who has to travel between different work locations during the day, say from one office branch to another, or to visit clients at their premises, you're in the game. If you're a freelancer using your car to meet customers, pick up supplies, or attend work-related conferences, then listen up. Small business owners who use their car for any business-related travel that isn't just the daily commute from home to their main business premises can also claim. The key here is work-related travel. Your regular trip from your bed to your desk, even if that desk is in your own business premises, doesn't count. We'll get more into that later, don't you worry. Understanding the rules might seem like a headache at first, a bit like assembling flat-pack furniture with instructions written in hieroglyphics. But trust me, it's worth the effort. The Australian Taxation Office, or ATO, has specific guidelines, and as long as you follow them, you're golden. This isn't about finding sneaky loopholes, it's about understanding your entitlements. Think of this guide as your friendly map to navigate the terrain of car tax deductions. We're going to break it down, keep it simple, and help you get what's yours. So grab a cuppa, and let's get started on making your car work for your tax return, not just on the road. When it comes to claiming car expenses, the golden rule is pretty straightforward. If you paid for something for your car and it was directly related to earning your income, you can probably claim a portion of it. It's all about the connection to your work. If you're using your car to make a delivery for your business, the fuel for that trip is a business expense. If you drive to a client's office for a meeting, that's work-related. The ATO wants to see that clear link. It's not just about owning a car, it's about how that car helps you bring in the bacon. This principle underpins all the specific rules and methods we'll discuss. So, what specific costs are we talking about? If you're using the logbook method, more on that soon, you can claim a whole host of things based on your business use percentage. This includes fuel and oil, the obvious ones. Then there's servicing and repairs, keeping your motor running smoothly. Don't forget registration and car insurance. Those are biggies. Even things like new tyres, cleaning costs, and interest on your car loan can be partly claimed. And the big one for many, depreciation, which is the decline in your car's value over time. All these add up, believe me, and can make a significant difference to your taxable income. Now for the bits the taxman won't smile upon, what you cannot claim. The biggest no-no is claiming your travel from home to your regular place of work. That's considered private travel, even if you pop into the post office on the way to pick up business mail. There are very limited exceptions, like if you're required to carry bulky tools or equipment that can't be stored at work. But these are rare. Also, any fines you cop, like speeding tickets or parking infringements, are on you. The ATO isn't going to subsidise your lead foot or your creative parking solutions. And of course, any travel that's purely for personal reasons, like a weekend trip to the beach, is out. This is where it gets crucial to separate your work trips from your personal trips. The ATO is pretty hot on this. You can't just guess or make a rough estimate if you want to stay on the right side of an audit. This separation is why the two main methods for claiming exist: the cents per kilometre method and the logbook method. Each has its own way of helping you calculate your work-related usage and ensure you're only claiming what's fair and square. Keeping good records is your best defence here. So let's dive into how these methods work and which one might be the best fit for your situation, ensuring you get your fair share without any dramas. Right, you've got two main ways the ATO lets you claim your work-related car expenses. You need to pick one. There's the cents per kilometre method, which is the simpler option. And then there's the logbook method, which usually means more moolah back if you drive a lot for work. Think of it like choosing between a quick and easy meal deal or cooking a gourmet feast. One is less fuss. The other can be more rewarding if you put in the effort. Neither is universally better. It all depends on your individual circumstances, how much you drive for work, and how much you like or dislike paperwork. First up, the cents per kilometre method. For the 2024 to 2025 financial year, the ATO has set the rate at 88 cents per kilometre. This rate is designed to cover all your car's running costs, including fuel, registration, insurance, servicing, and depreciation. It's straightforward. You just multiply the number of work-related kilometres you've driven by 88 cents. However, there's a cap. You can only claim a maximum of 5,000 work-related kilometres per car per year using this method. That means the most you can claim is $4,400. You don't need written evidence for your actual car expenses, but you do need to be able to show how you worked out your business kilometres, like keeping a diary of work trips. This method suits people who do occasional work driving. Then there's the logbook method. This one requires more legwork, but it can lead to a much bigger deduction, especially if you use your car a lot for work or have high running costs. You need to keep a logbook for a continuous 12-week period. This logbook must record every journey, both work and private, detailing the date, odometer readings at the start and end of each journey, kilometres travelled, and the reason for the trip. If it's work-related, be specific. From this, you work out your percentage of work use. For example, if 60% of your kilometres in that 12-week period were for work, you can claim 60% of all your actual car expenses for the whole year. You'll need receipts for all those expenses: fuel, insurance, servicing, the lot. So, which one for you? Let's say Sarah is a therapist who drives 3,000 kilometres a year visiting clients. Using cents per kilometre, she claims 3,000 times 88 cents, which is $2,640. Easy. Now consider Tom, a sales rep who drives 20,000 kilometres a year for work. He can't use all those kilometres with the cents per kilometre method. It's capped at 5,000 kilometres. With a logbook, if his total car expenses were $10,000 and his logbook showed 70% business use, he could claim $7,000. That's much better than the $4,400 cap with the other method. The logbook is more effort tracking every trip for 12 weeks, keeping all receipts, but often worth it for high-kilometre drivers. You only need to complete the 12-week logbook once every 5 years, provided your circumstances don't significantly change. When it comes to getting a car for your business, you generally have two main options: leasing it or buying it outright, maybe with a loan. Both have different impacts on your cash flow and, importantly, on your tax deductions. There's no one-size-fits-all answer to which is better. It really depends on your business needs, your financial situation, and how you prefer to manage your assets and expenses. Understanding these differences is key to making a smart choice that benefits your bottom line and keeps your tax affairs tidy. It's about finding the right fit for your specific journey. If you buy a car, whether with cash or a loan, it becomes an asset of your business, or your personal asset used for business. You can then claim a deduction for its decline in value over time. This is called depreciation. If you've taken out a loan to buy the car, the interest portion of your loan repayments is also deductible, based on your business use percentage, if using the logbook method. Buying might suit you if you want to own the asset long term, you do a lot of kilometres, or you want to modify the vehicle. It often means higher upfront costs or loan commitments, but you build equity in the vehicle over time, which can be a plus. Leasing a car, on the other hand, is essentially renting it for an extended period. The lease payments are generally fully deductible as a business expense, provided the car is used 100% for business. If there's private use, you'll need to apportion it. One of the big attractions of leasing is that it can free up capital, as you don't have a large upfront purchase cost. It can also offer more predictable monthly expenses and the ability to drive a newer car more often, potentially reducing maintenance worries. This often suits businesses that want to maintain a modern fleet, prefer fixed costs, or don't want the hassle of selling a car down the track. There are different types of leases, like operating leases and finance leases, each with its own accounting and tax treatment, so get clear on what you're signing up for. Regardless of whether you lease or buy, or which deduction method you use, keeping accurate and organised records is absolutely non-negotiable. The ATO can ask for proof of your claims, and if you can't provide it, you could face penalties, not to mention having your claim disallowed. This means keeping receipts for all your expenses, fuel, servicing, insurance, and so on, maintaining that logbook diligently if you choose that method, and clearly showing how you calculated your work-related kilometres or business use percentage. Digital record-keeping apps can be a lifesaver here. And please, if all this sounds like too much, or you're unsure, get professional advice from Barontax and Accounting registered tax agent. They live and breathe this stuff and can help you maximize your deductions legally and avoid any costly mistakes. Tax time doesn't have to be a nightmare. A bit of smart preparation now can save you a bundle and a whole lot of stress later. You've got this. Thank you for watching.